Hello, good evening everyone. Welcome. What a magnificent setting, I have to say. It's my first time here, and a beautiful Sydney evening to enjoy it. Welcome to our exclusive evening as we explore Sydney's dynamic real estate market, guided by dynamic experts from the front line of property, just setting expectations high. I'm Vincent O'Neill, the CEO of Stamford Brown, and I'd like to begin formalities this evening by acknowledging the traditional owners of this land on which we meet this evening, the Gadigal people of the Eora Nation, and I pay my respects to their elders past and present. Now, in terms of our running order for this evening, in a moment I'll call up Todd to introduce our panellists. We're going to enjoy the panel session. Rob, chairing the panel, will be guiding the teams through a variety of questions, and we'll take opportunities potentially to throw to the floor for questions where relevant, but we will allow our panel chair organise that before the chance at the end to certainly have a few more questions and close. Before we dive into that, I'm just conscious that for some of you in the room, you may not be familiar with Stamford Brown. So who are we? We are a privately owned, holistic private wealth and private office firm. We work with over 800 family groups across areas including investments, planning, tax and structuring, insurance and intergenerational wealth. And we directly manage over $2 billion in assets for those families. Tonight is somewhat different from our usual fare. We hold regular events across topics such as investment market outlooks, investment deep dives on private debt or private credit, or even events on navigating intergenerational wealth or transition to life after full-time work. But tonight, we thought we'd hand over to the property experts for everyone's favourite dinner time or after dinner conversation. What's my house worth, and is it going up or is it going down, and what's the next hot area? Before I hand over, I thought I'd like to share a few fun facts about this splendid venue for this evening. So we're at the Sydney Mint, which was in 1811, Governor Macquarie commenced planning for a new general hospital in Sydney, which was to be his first major public building. The contractors were paid 45,000 gallons of rum, hence the colloquial name for the Rum Hospital. Construction was successfully completed in 1816, and given that the building is still standing today, I'm guessing most of those $45,000 barrels were paid upon completion rather than the outset. So that was a sort of an early building lesson learned there that probably hasn't been continued to be learned and maybe forgotten over the years. From 1955, it served in that purpose through, to 1855, and then the British Secretary of State gave acceptance from the colonial government to establish a mint in Sydney, which was to be the first branch of the Royal Mint outside England, and that was here. There were frequent major upgrades to the mints during the late 1800s and through to the early 1900s. However, by 1926, the Melbourne and ultimately Perth Mint, having much better technology and being more profitable, the mint was closed. So since then, it's had served various functions across government offices, law courts, and a museum from 1927 to present. Now, it's a long and storied history, but I've got no doubt what we've planned tonight will go down as an important event in the history of this storied building. And on that front, I would like to introduce Todd Stamford, who is the partner here at Stamford Brown. And Todd has been working tirelessly for a number of months to corral all-star cast of speakers for you and organise tonight's event. So can you please welcome and thank you, Todd.
Thanks very much, and thanks everyone for attending. Just jump ahead. So I might call up the panellists now, if that would be great, Rob. You're still making a few notes. Thanks. So my role is just to give a brief introduction to our panellists, each of whom will have a unique perspective on the property transaction. So firstly, I'd like to introduce Robert. So Robert's a former property editor and now columnist for the AFR. Rob joined AFR as a young property writer in February 1988 and has written about real estate, commercial and residential, for over 35 years. Rob is kindly facilitating the panel tonight, And he's previously done the same for the AFR for notable figures such as Westfield's co-founder Frank Lowy and Meriton's Harry Trigloff. So welcome, Robert. Next we have Byron, who I've known Rob for a number of years, and I've met Byron more recently. Byron's the co-founder and managing director of Rose & Jones, a well-established buyer's agent and asset manager. Rose & Jones started in 1998 and over the past 27 years has purchased around $5 billion worth of property, representing around 2,000 individuals, families and companies. Byron and his team, several of them are here tonight, are based out of Paddington, and they have a second office on the Gold Coast servicing the Northern Rivers and the Byron Bay regions. So Byron has 36 years of experience in residential and commercial property acquisition, leasing and asset management. So thanks, Byron. Next I've got, I'll do Jake. The way around. So Jake's an auctioneer and partner at Cooley Auctions here in Double Bay. Cooley Auctions has been in operation for over 20 years and is Australia's largest and most award-winning independent auctioneering company. Jake has conducted thousands of property auctions and built a vast network of loyal, high-profile agents. He's been the presiding auctioneer over 58 sales exceeding $10 million with an average price of $2.4 million. So, welcome. Okay. And lastly but not least, I'll introduce Sam. So Sam Hill is a real estate agent and owner of John Hill & Co, a successful inner west agency in Burwood, which his father John Hill founded in 1977. Sam began his journey in commercial real estate in '92 as a letting agent, working alongside his dad. In 2013, he and his wife acquired the business and has since expanded into commercial property management, strata management, and sale and leasing across metropolitan Sydney. He and his team have facilitated $67 million worth in commercial property sales and successfully negotiated over 75 leasing deals. So, thanks. So, I'll get down and thanks again, and I'll hand over to Rob.
Thank you very much, Todd. You've got a very good panel here. Actually, I've worked out there's over 70 years of real estate experience here. So if you've got some questions, please don't know. There's plenty of time for questions. Okay, can I start with a few questions for the audience, just to give the guys an idea of who's here and who should be talking to. Just a couple. Who, for example, has a residential investment? We just have a show of hands. Oh, that's pretty. Yeah, there we are. What about a commercial investment? Yep. And who's got a indirect property investment? Todd tells me everybody should have one. Which is a property trust or syndicate. No, that's cool. And your next property move, your property journey, what's the next thing you know? Do you intend to buy another residential investment? Who intends to buy an investment? What about selling? Well, we've got more buyers than sellers. That's always good. And what about downsizing? Who's thinking, and buying something for the kids, for the next generation? There we are. I think that's about what we thought, is it? What we had here? We're going to start with a big picture view of where the market is at the moment. But then we can pause for some questions, and then we'll go into some little more nitty-gritty stuff like the details, auctions, management, and this sort of stuff. So to start off with, I thought Jake is at the cutting edge of the market. Can you tell us what your auctions are telling us?
Coalface.
At the coalface, right. Tell us what the auctions are telling us at the moment. And this is what you...
Yeah. So we track a lot of our stats, and we're mainly based in the eastern suburbs. That's our core market. We have a big Sydney metro hold as well. But I don't know if everyone can see that, but we've basically got here February 2025 versus February 2024 last year, and it was quite interesting looking at the stats, and everything is almost basically the same. Like, we did the same amount of auctions, the clearance rate's only up this year by about 5%. What was interesting was the average sale price, and that was come down. So that's either us just not auctioning the more expensive homes, but I think it's more, and what we're seeing is that the prices have come down a little bit, I think, in the core market of where we're auctioning at the moment. So buy numbers are up. We've definitely seen competition along a lot of auctions. I think that those expectations have come down, which is why we're seeing that clearance rate coming up a little bit from the same time last year. Last year, it was a little bit of a hangover. People were thinking that their property was worth a little bit more than potentially the market was, and that's why we're currently seeing the clearance rate jump that little bit extra, whilst this average sale price is down.
Because I went to your auction on Tuesday in Double Bay,
Yeah.
and there were, in essence, 11 properties, 4 sold beforehand, 5 under the hammer, and 2 passed in, which sounds very good.
Sure.
But there was a lot of negotiation going on, a lot of toing and froing, a bit of, the vendor, we have talking the vendor down, you only had one buyer.
Yeah.
Is that what's happening in the market?
Yeah, we're seeing that there's still a gap between, obviously, buyers and the sellers. There are standout properties where they're having a lot more, which is why you kind of see that the average buyer's coming up. But I think another stat that is quite interesting is when we're seeing that is that there is about 4 out of the 10 properties that we're taking to auction are selling prior. Now, is there a strategy between that? Maybe Byron can kind of weigh in on that. But that is either that the owners are getting an offer that is far too good to say no and too much to risk to go to auction, or potentially could it be that the pressure has been put onto that to somebody because they may be the only buyer and they're wrapping that property up before it gets to auction, before that buyer sees they're the only one there. So
But perhaps I should bring in Sam. I mean, you do a lot of auctions, Sam. Why would you sell something before auction?
Because you're not going to get the money on the auction day. It's that simple. But I think it's also why people are selling, and I'm not sure in the residential market, but we're seeing a trend in commercial that majority of their owners are 60 and above, and there's quite a clear divide where you could say 50% prefer to do the squabble in front of them and give the money to their kids to move into a home and see what that capital will do to their kids' and grandkids' lives. Then there's the others that say, well, unfortunately there's no one to run it, so we're going to split up and we're going to return capital. And then there's the vendor who owned a company, ran a business, but to be honest, they're just tired of it. They're tired of rent renegotiations. So we're seeing it, and what's noticeable, we've had 13 interest rate rises and one small little token. None of it is under economic pressure in commercial. That's most probably due with the large deposits you need to own commercial property.
Yeah. But for Byron, and you're in Resi, is that what you're seeing? I mean, this is the latest CoreLogic stuff, and monthly move, and you've seen that the monthly thing did trail right off at the end of last year, their CoreLogic figures in Sydney, but they kicked up in February. Is that what you're seeing?
Yeah, we are. We're seeing, I've always looked back in the rearview mirror to potentially answer some of these queries and concerns out in the marketplace. We've always pitched back in June, July last year that August, September, October was probably the purple patch in the residential market.
But for buying?
For buying. Now, what we're probably not dissimilar to what Jake has outlined, we're seeing probably more choppy waters out there at the moment, a bit of patchiness, and that is crept from the lower end of the market, which is still a lot of money in this town, anywhere from sort of 800 to 1.25, and that is now filtering up into the luxury in town as well. So, yeah.
I'm sorry, so are we seeing some top-end properties actually drop in price.
Yeah, interestingly enough, I've noticed over the last sort of 4 to 6 weeks that top-end real estate is starting to show some cracks in their values, and on that basis, we're pretty confident that they're not interest rate sensitive owners of real estate. There are other factors at play, and what we're also seeing is anywhere between sort of 10 and 15% discount to what was previously seeked to where they're actually trading.
And what do you think's the outlook? What's the 6-month outlook?
Good question, and that's the crystal ball that everyone wants the answers to. I'm pretty confident that what we're experiencing right now will continue for the next 6 to 9 months and maybe longer. I don't know what it is in this city that every time we have a state election, federal election, everyone believes that the world or the economy in this country is going to come to a grinding halt, or it's going to accelerate, but no one wants to do anything for that period. I suspect once we know if it's a new government or the existing government, that Sunday or the Monday, the economy is just going to be the same. And my belief is that a little bit of pent-up demand will start creeping back into the market post-election.
And what does the current turmoil on the stock market, bond rates, what does that do? Because
Historically, I think everyone would agree that when we see turmoil in those markets, that people do tend to gravitate to real estate as a safe as houses cliche.
Rob, I think it's like at a dinner party, when you look across and you see people a bit down, and you know they've got a lot of money in the share market, and then you look across at the other side and everyone's smiling, and you go, oh, I must be in property.
What's the sentiment in commercial? Tell us what the sentiment amongst the tenants, the people who occupy property is at the moment.
It is totally based on where the property is. And if you follow some fundamental rules in commercial property, and I was just sitting here thinking of a good example, and for instance, we leased, repositioned 3 shops in Burwood late last year, all in December. We got 20% increase in rents. Now they were prime, so they were between Westfield to the station, but that is a direct result of the development that has happened in Burwood. So the rule is in retail property. Doesn't matter what they're worth. I'll only buy 1 cup of coffee and you only get $5 out of it. So what you need more people. So if you're investing in retail property in a growing population, just rents go up. So we look at that compared to, say, the old CBA Bank on Pacific Highway at Linfield. Now, the North Shore, that ain't going to grow. It's what it is now, and it's having a transition to a younger people, but there's no more population. So that rental went from, they were paying in 2010, I think they were paying $260,000 a year, and the last offer we got on it was $110,000. And then the owner just sold it. So we look after around 900 tenants, and I'm seeing at the moment there's no cracks in rental arrears. So any arrears problems we've got, they're self-inflicted.
So, and what about the sentiment in the tenants? I mean, Knight Frank had a wealth report out the other day, and they reckoned that 44% of the global high net worth families' offices surveyed around the globe would increase their allocation to real estate in the next 18 months. Does that make sense to you?
Very smart people. Well, say for instance the 3 shops, we had 9 heads of agreements signed, so that means we had 6 people who were missed out. So for good quality, and it's all restaurants, it's suiting the population. If you look at the bottom end of Parramatta, if you look at some of the developments in Penrith, look at some of the stuff that's going to happen in Willoughby, there's some pretty good stuff there. That will always do very well.
Okay. Can we look just a bit on the next 6 months? Well, we've had some extraordinary house price growth in the city. Australia, around the world. Do we expect that to continue? By now, can you expect your house will be, your property will be close to 70% more expensive in a decade's time? Who wants to take that?
Is this me?
Yeah, you.
Okay.
Yeah.
I think if you look at Sydney as a whole market, everyone's addicted to real estate in this town, and it is a source of wealth creation, and it's our last tax-free haven. So everyone utilises the family home as their strategy. Is 70% value compounded over the 10-year period? Is it possible? Yeah, anything is possible. However, when you read articles, I'm not sure if everyone read the article last night in The Australian about the Kirribilli development that's going through with, they've got a price tag of $65 million for the penthouse. And that penthouse they didn't disclose what the internal area was. However, the rate that they're seeking per square metre is going to double, if they achieve the result, going to double the last record in the city. So they're seeking somewhere between 260 and 265,000 a square metre. So I think we can move down the rabbit hole here with some of these slides and discussions around development, the downsizer market, and my views on where this market may end up. But if they do achieve that result, that really does throw the downsizer market and prestige market out of kilter in quite a dramatic way.
Well, I'll get to that.
Yeah.
I was wondering, are we going to see a $200 million house sale in Sydney in the next 5 years?
Yes. Yeah, that will happen. For
Well,
sure.
I mean, I've got up behind you.
Oh, right, okay.
Is
There
your
you go.
slide
Yeah, okay, well,
about
that,
the
yes.
harbour?
Okay, so one of my colleagues, Shakira, and I, we spent, when we're not working hard in the BA space, we analysed all the waterfront properties, and I know a lot of you are probably Lower North Shore and other locations, but we are getting to those locations. This slide up here is, we utilised Google Maps, RP data and Price Finder, and from Google Maps we analysed every single property and correlated or cross-correlated to RP data. And that just shows you there is 236 waterfront properties in the eastern suburbs from Watsons Bay to Darling Point. And I can fast track this, so then when you look at that and the amount of people that live in this city who have an aspiration to own real estate and who do own real estate, there is this domino effect from the top to the bottom. And when you see numbers like that, they get traded possibly once, sometimes once every 10 years, majority every 20 to 30 or 40 years. And there was a deal done in Vaucluse, Point Seymour, that had been in the family for 50 years plus. So some of this real estate gets locked away. When that real estate is locked away for so long, that domino effect goes all the way down to other price points. So each family member or owner of real estate is getting the knock at the door. Here's the value, here's a price, we're prepared to pay X over and above where the market might be. But the occupant of that property is saying, well, where am I going to go? And this is a systemic issue that we have in Sydney real estate, and not just in the prestige market, but it moves all the way and funnels down to your 750 first home buyer acquisition as well.
Jake, you were talking about something in Vaucluse the other day.
Yeah. I also, just between that as well, a waterfront that we sold 2 weeks ago. It's kind of, I don't know where it actually relates into it, but we auctioned it mid last year. We had a reserve of 38 million, waterfront property in Watsons Bay, and at a reserve of 38 million. We got it to 36 million, and the owner decided that they weren't going to sell it, they were going to keep it. 3 weeks ago, we re-auctioned it with a reserve of 36 million, where we got to on the day. It ended up getting to 35, and then after it got to 35 and a half, and they ended up selling it. So that was something there of the waterfront that.
But we're also
It's
seeing
interesting,
a
yeah.
little bit of weakness in this market too, aren't we?
Yeah, there is weakness at the top end of the market, and I think as I said earlier, that isn't a reflection of interest rate environment. That is a reflection of sentiment and reflection of what is happening locally and globally as well. I mean, we can get into the political discussion and we can fall down the rabbit hole there as well, but there's a lot of disruption going on, and that goes to disruption, federal election. People have got their fingers on the trigger, ready, wanting to do deals, but just aren't prepared to do deals in the resi space at the moment. They are occurring, but not at a fast rate of what we've experienced in previous years.
Is that just they're revaluing risk? Like they might look at a property and say, look, I'll say commercially, it doesn't have a real aim. Whereas they just saw so much 3 years ago, there was so much heat and prestige to buy certain properties in areas. They said, I'll just buy that at 2.5% net. Whereas now they're saying, I don't really want to pay 2.5% if it hasn't got a real aim or if it's got a structural problem.
Correct.
I think we're seeing across the market that there's now being put true values on defects of properties.
Thanks. I was going to look at, hopefully we look at this graphic, which shows the different parts of Sydney have grown in price quite differently over the last decade. And I thought we might be surprised that some of those are the outer areas. Does that surprise anybody?
Yeah, well, I've looked at this slide a couple of times today, actually, and I've been trying to come to a conclusion and a sensible answer as to why this actually occurred. And my answer is this: I want to see the previous 10 years to that slide,
That's right.
and I think you'll find the ones that are in the bottom section who have not increased in value considerably compared to the outliers above, that they have or possibly had their growth in the previous 10 years and may have had a subdued growth period through the balance of that last 10 years.
You know, but you've got a view, right?
Well, I think it also, when it comes down to, and you can break it down even further, is of micro markets, where you find that potentially you might see that Parramatta has dropped, but you might see that, you know, Rouse Hill or somewhere that maybe not have people would have bought before. Now I can't afford Parramatta, so where do I go to next? I go to an affordable suburb, and then when people are saying, oh wow, I can get this for my money here, they tell their friends, and then it kind of gets on a bit of a roll. That's when you see the growth in those secondary, or I don't want to call them secondary markets, it's the actual suburb, but you find that people will gravitate to somewhere that is cheaper, and then that price growth you'll see there because they're priced out of a certain suburb or area.
A colleague who used to work for us used the phrase that money's like water, it'll find its level, and that's why you find that the surrounding suburbs to a prime location that may have had experienced really good growth is their surrounding suburbs start to trickle through. And I remember Willoughby used to be one of those, you know, you'd find that families from east of Lauren or Shore couldn't buy into the markets they were accustomed to or who were raised in those suburbs. Willoughby became the next flavour, and that was back in the early 2000s. It's experienced tremendous growth.
Are those areas that haven't done so well? To me, it just looks like a lot of units have been built in those areas.
I think that's
And it's affected the me. Because historically, residential prices grow or go backwards, and it used to be on employment. So if your suburb or region had bad employment, you had no price growth, you even went backwards. But this full employment, I think it's now starting to look at the mean incomes to those areas, and you see those mean incomes for those areas have grown a lot more. So it's maybe moved from employment statistics for an area to mean income.
And I think people would be surprised that Sydney inner city has performed so badly, but that includes Alexandria and Zetland and all those places. And yeah, and also, I keep using it as an example, Epping, you know, full of units, and those units have gone backwards in price over the last 5 years. And it's very interesting. So Sam, when you were telling me if you had one place to buy in Sydney,
Residential.
residential, where would it be?
Paddington.
Why?
because everyone keeps on asking me where's the next Paddington, and I say Paddington. I had a client, and he was a wheeler dealer from New Guinea, and I asked him, I said, what is your best deal and your worst deal? And he goes, they were the same deal. I bought 17 6 metre terraces in Paddington for $280,000. And I sold them 9 months later for 7 million. And I go, that's a great deal. He goes, I just wish I had them today.
Should have, would have, could have.
I mean, the government does talk a lot about well-located apartments, but there seem to be some problems with it. You know, there are some issues with apartments, with stratas and construction and oversupply. I mean, would you buy an investment apartment in Sydney today?
We through Rose and James, we're pretty diligent around what sort of apartments we would be buying for our clients, whether it be off the plan or already established. If it is off the plan, for example, if you're interested in that space, we want to know who owns the land, who's the developer and who's the builder, and understand their track record. I think that is vital to really achieve the growth and your yield on that sort of asset class. But a lot of people have been caught out in buying and get razzle-dazzled by the
showroom.
Thank you. The showroom where there's teas, coffees and beautiful drinks and all this sort of stuff, and they get razzle-dazzled by it all, and before they know it, they put the $5,000 deposit down, and it feels like it's a reasonably good deal at the time. 10 years later down the track, you're talking about Epping. But the answer is yes. We're an advocate to buy in Sydney, but are very selective in the locations and the type of acquisition.
Right, you
Yeah, I think exactly what Byron said. If you're looking at off the plan, you want to know exactly their past record and the buildings that they've previously done before. And then also just having a really good solicitor and having someone who can really understand strata reports and making sure that you're going through those with a fine tooth comb, because like you said, the scene that Alexandria, the Zetland Market, and then you obviously go to those buildings in Mascot where not only are they falling down or having to have the recladding due to the Greenfield fires, there's a lot of money that you can be losing there in strata fees, getting those buildings redone, and it's not making your property any better. It's fixing things that probably should not have ever been there in the first place. So I would also, if you're looking at investing in units, in something maybe that's even 15 years old from that, just be really diligent in that you've got a full strata report, you've looked through what the minutes are and what the updates of the building are. Always buy Updeco and Paddington, right?
I had an engineer at my place the other day, and I asked him, what is the year above which you shouldn't buy property? He said 1997, and there must have been a turn in the type of builder in Sydney in 1997.
Do you know who it is?
But I think on units, Robert, it's horses for courses. Like for a 25-year-old, if you get into an $880,000, $900,000 unit, like it's means to an end to get onto the property ladder to where you start to where you finish. The only thing, as I say about buying units, is just look at the supply. So if they're just going to build more and more, you go down to Melbourne, they just open up more land. Sydney's lucky. But if they're just going to build more and more units, well, you're going to go into that market and really, my dad always said, buildings go down and the land goes up. So if you're buying a higher building content, that means that you are going to depreciate fairly quickly.
I mean, to add to Sam there, I mean, the heading that we used on that waterfront point where scarcity drives value, I'm talking about the Alexandrias, etc. If you buy and you look to sell, you're going to be competing with 50, 60, 70 other apartments to divest out of that asset. Equally, when the tenant runs out of their lease term and you go to market to re-let it, again, you're going to be competing with a lot of other investors in that marketplace. So you can utilise the phrase scarcity drives value in all sorts of asset classes. You can invest and buy an apartment in Sydney, but look for locations that are going to be unique and that are the old recipe: transport, amenity, get multipliers of transport, train and bus, or train and ferry, for example. They're important factors to be considering. That way you won't wash your money away down the drain.
And Sam, what about a small commercial investment for the next decade?
If you run your own business, you just need to own the property you're in. There's so many tax advantages, particularly for a small to medium business, as a good way to get money into superannuation. Small, just depends on the class you're looking at, and you've got to be disciplined when you buy. As I've already told you, what is a good retail opportunity. Now, another good retail opportunity is where there's services on the ground floor. We talk about medical, and we have a little saying in the office. It's a good investment if the tenants put a fair bit of hurt money into it. So if you have a look at a dentistry, they generally want 1 to 1.5 million. If they leave, it hurts them. So look for that when you're looking for a retail investment. I think office, small, is going to be run-of-the-mill. I think it's, they're very good investments when you operate them. Funny thing at the moment, in commercial office, our biggest inquiries over the last 12 months, we track our inquiries and what level, or what size, and it's all been 100 to 180 square metres. So that's, in office talk, that's 6 to 9 people. So that business has moved, and we've seen price growth.
So you haven't seen the big space movers move?
It did, and it hurt. So what's happening in the large end is, if you're looking for 2,000 square metres, or you can get a deal with. So the way they do it is they have what's called a face rent, and then they do a side deal, which everyone knows about, so it's really clever. It's called an incentive. So it's $1,000 a metre. And it's a 5-year lease. They add up all the years that you're going to pay, and then they'll give you an incentive on a percentage. Now,
tell us what it is. That's what we'd really like to know. What's the percentage that you get in the incentive? Parramatta. Ask me Parramatta.
46%. Which, I don't know, why don't you just say 500 a metre? Why kid yourself at 1,000? But anyway, look, I'm sure there's a reason behind it. It might be they paid on the capital value or something like that. But the reality is if you've got a big liquor space, efficiencies in computerisation, AI hasn't hit the majority of businesses yet, that's coming, and work from home. But it's really, we've seen in the last 25 years office space go from 1 person per 20 to 22 square metres. Now, hot desking in town here, they trialled it down to 1 to 8. Now, they've all said that doesn't work, but 10 works. 1 to 10, good on it. So,
And what about small industrials, more logistics? What would you suggest there?
It's seen amazing growth, okay, and that's just purely because an industrial factory, you used to work on 4 to 5% of gross turnover, and that's what a factory could, an engineering shop or a warehouse or something like that. But since the internet, they're actually quasi-retail now. So they will pay up to 12, 13% of gross turnover for rental. So we've seen rents go from $100 a square metre 10 years ago to $300 a square metre.
So there might be a place to pause, because we're going to shift into a bit of nitty-gritty. We'll talk about options and buyers, agents, and so on. Does anybody have a question at this moment that they'd like the panel to address? There's plenty of There's plenty of expertise there. That's cool. The questions are being saved up.
Tough crowd.
Sorry.
Just in terms of borrowing, perhaps you're thinking of Sydney, if I was going to spend a couple $1 million in Sydney buying a house to invest in, so thinking, or if I was to try and deploy my capital in, let's say, Newcastle, do you have a view on that? Where the difference in Newcastle, I get more land,
Yeah.
which potentially is less developed, therefore has more upside, but do you buy into that or?
Look, I think Newcastle, I don't know enough about Newcastle to give you a clear lens on it. However, Newcastle has experienced tremendous growth. If this is about investment planning or an investment acquisition, either one, I believe from a yield perspective is going to deliver. Probably Newcastle will deliver a higher yield. From a growth perspective, I still hang my hat on Sydney. And I say that because Newcastle over the last sort of 5 to 10 years has experienced some pretty good growth, and there's a lot of development up there at the moment. So if it was a home acquisition that you're talking about, that you wanted to, then it's purely based on your desire and your family structure and what you want to do. If you want to live up there, great area, Central Coast, awesome place, great surfing too, by the way. And equally, you know, Sydney, depending on what your work environment is. So, but yeah, it's a great market. I don't know enough granular information in order to give you, you know, probably a clear view on that point.
Jake, you do a bit of auctioning up on Central Coast in
Yeah.
Newcastle. I mean, can you give us a perspective of what's going on at the moment?
Again, I was going to say, it comes back to these micro markets, and there's a suburb up in Newcastle, South Newcastle, called Gateshead. And the last 3 auctions I've done there have all come off the back of one sale where, you know, I think the highest sale price in that suburb was around 650 to 700,000 for a house on about 650 to 700 square metres. One sale ended up being 850, the next sale was 900, and then the sale after that was 920. So again, micro markets, and if you can pick them, and if you want value for money, that there are a lot of people are seeing that they can still buy, which in the suburb they're thinking, oh my gosh, that sold for 950,000. But if you're coming from the outside and you can get a decent home on 900 square metres in a very quiet street that's close to the beach for 900,000, it's a no-brainer.
Oh, another question. Yes, please.
I'm just wondering, do you think the closure of the power stations up there is going to impact the property market that way?
I should be actually asking Jamie from my office because she resides up there. I would have to say, if I was going to have a bet, I would say yes, and it would be a positive outcome. Yeah, with the closure up there. I understand where you may be heading to with the employment factor of that and people retracting or moving away. I don't know the statistics of how many people are employed in those stations, but I'm sure there are a number. However, you know, it could be controversial, but is coal going to go away anytime soon? I don't think so. I think all forms of energy in this country and globally will be around for quite some time. You know, battery, solar are just going to find their place within our system.
So if you were comparing residential to commercial real estate, what are the ongoing costs and considerations that would be different? For example, insurance, land tax. What sort of costs do you have to be aware of if you're going into commercial for the first time?
They're most probably the same. Like if you're buying strata, you've still got strata fees. Strata is set up on the value, it's not on the size. So because they're generally larger, you will have a high percentage of strata fees. I think maybe the question's leading to what I look out for when I buy a commercial. And you've got to look at why you're buying it. So what stage you are in life, and this is where great companies like this company here talk to you about, hopefully go through and say, an agent works best to say, I've got a property at 6% yield, it's a dentist, it's there for 10 years. Now that's really good for someone who's retiring and they're not confident in the share market, or they're getting a bit worried about first mortgage, but they look at it and they say 10 years, tenant pays the outgoings, strong tenant and a good bond. So that's a good deal. But if you're in your 30s, you might look at a property that's got a development angle on it and you are purely capital gain. I don't care what it produces each year. If the land tax goes up, that's unreal because that means I'm making more money. So it is unique to you, and I think that's the beauty of direct property investment. Whereas, you do have control over. You can personalise your investment.
But Sam, I mean, the yield, the net yield on resi must be a lot lower than the net yield on industrial.
I don't know why people do it, to be honest. In all fairness, and then you go to a strata meeting and they say, oh, the lift needs redoing.
I think there's a place in anyone's property portfolio, if you've got the capacity to do so, is to have commercial in there. I don't think anyone should be solely focused on residential 100%. There is definitely a place for commercial, and I love commercial real estate. I mean, when you're getting 5 by 5 year leases or a 10-year straight lease, you may not get the same capital appreciation as a residential apartment or Paddington Terrace house, for example, but you've got continuity of income so long as the covenant on that asset is I would say B plus to A grade, and if that's the case and you've got a bank guarantee, minimum 3 months, there's good security around your commercial asset.
What would you talk?
And exactly what you're saying, it's all about risk profile, where you are in your life. So someone younger with more, an appetite for more risk, we talk about repositioning properties. So you go and find a property that is under-rented, you know that it is under-rented, but you're brave enough and you say, well, I'm going to kick that tenant out because that business cannot afford the market rent, and I'm going to reposition it to a tenant that can. Now, not everyone has that bravery. Is that the word? Or
I think you've held my hand a couple of times, Sam, and said, we should do this.
It only went off track a couple of times.
So if you're looking at diversifying into commercial and you know very little about it, what should you be thinking about in terms of what type of investment would you do in real estate, in commercial real estate, and what would be the price point that it's going to cost to buy into that? So it's a very vague question, I know.
No, it's a good question. So I think I can answer that, is what the minimum is to sort of get into a decent commercial investment. And I think you've got to be looking at $1.5 million. But we have a saying in real estate, unfortunately, the agent's always the last to know of a market move, okay? We think we're great, let me tell you. But, you have these auctions and they go nuts, or tenants come from nowhere. They knew weeks before us, okay, what was happening. The only thing I'd say to you is when you're looking for a commercial investment, think like that tenant who's in there and imagine if it's vacant and say, where does it sit in this market? So you're not overpaying for an inflated rental, and you have a look at the volume that happens in that suburb. But if you follow the rules, pretty simple rules, but you've got to be disciplined.
Step into auctions now. We hear a lot about auctions, good, bad, indifferent. Firstly, from the owner's point of view, from the vendor's point of view, what makes a good auction? Jake, if it sells at the right price, but what goes into making that?
The second bidder.
Yeah. And how do you get it?
They say you only need one sometimes.
Look, I think we chatted as well about there's the age-old when you see a property and it's mortgagee in possession or it's deceased estate, and it's always I find it quite weird when you see a big ad on realestate.com, address, auction, deceased estate. It's just like wouldn't you think that just a bit of privacy. But what that I feel like the mindset to what people actually see when they see that is, oh, this has to be sold. So people get it in the idea of they actually come along because they think, well, if it's got to be sold, I might pick up a bargain, but it's also in a good area, I'd pay a fair price for it. So I think when you have a realistic, we say this all the time, when you have a very realistic owner, the price tends to be better than if you had someone who's after a very high price in the market, and especially what we're seeing at the moment. Even if you've got multiple parties and they're bidding rapidly on something, yet it pulls up short of the reserve, we're finding it very difficult to close the gap between the owner's expectations and the highest bidder. Whereas if you've got somebody who's potentially calling the property on the market whilst that bidding is currently keeping going, people get it in their minds, okay, well, it's on the market, we're playing for keeps, and we might actually keep going. And they almost forget about where they were, they're just thinking about, okay, another 5 and we might get it. Okay.
Which is a strategy for a vendor, is it? If you're a vendor, do you put it on the market?
Yeah, I mean, look, obviously there's risk there, because if you say the property's on the market and then no one bids, you've got to sell it. But yeah, there is a little bit of a, and then there is also people who have strategies of, I'm not going to bid unless the property's called on the market. So we kind of have to wade our way through that for every different option that we do.
And what is, everybody seems to have a strategy for being the winning bidder at auction. I mean, there's three experts here. Byron, what's the best strategy? What's your strategy?
Oh, look, I've got a number of different strategies, but I deployed one on the weekend actually for a property where there was a reasonable amount of competition. We had a reasonable budget, and there were 4 bidders. 2 of them dropped off, and it was just us and one other. And every time the other party bid, I was without hesitation straight into them, without any hesitation. Fast forward, we got the property by the skin of my chinny chin chin. We only had a few shekels left. Anyway, after the auction, the underbidder was waiting outside and we were having a chat, and they said, well, you must have had so much more money. And I said, no, we only had $5,000 left to play with. And they were not in, they broke their heart, putty in my hands, I had them. So they weren't overly impressed, but that was the strategy on the day, was to demonstrate to them that this is going to be my client's property. And
So you keep it, you don't have to come in at the end, you just...
No, I mean, look, as I said, there's many different strategies. Sometimes one of my strategies is I open up the bidding and then I'll let everyone else participate just to see who my competition is, how many bidders actually are. These guys here, they may register 10 people. I open up the bidding, there's only 2 or 3 people bidding on the property, and then we start getting ourselves involved. But yeah, I don't think there's a silver lining or a silver bullet or one strategy fits all auctions.
Jake, you must have some thoughts on this.
I think if you're going to, I'm going to try and make it too hard for myself. My business partner Damien has a video out there that kills me every time. Is that bid in odd numbers and different numbers. And I don't know if anyone watched The Block, but you've got that bloke there who bids in the most annoying numbers. And I said to him, mate, it's all your fault. But I would say if you want to control the bidding is a big part, because my job there is to try and control where the bidding goes, and obviously to try and move it as quickly as I can in the largest increments that I can. So, a strategy, it's not going to work with me, but a strategy would be, so say, you're going for a property where you probably think it's worth around the 1.8 mark. Now the agent might be guiding 1.2. No, I'm kidding. The agent would be guiding 1.6. The agent will be guiding 1.6. And, I might get up there and I ask for an opening bid around 1.6. Now, that would be 2. If I get an opening bid at 1.6, I'm now going to try and move it forward in quarters. So I'm going 1.6, 1.625, 50, whatnot. What you can do, and maybe if you get, say, an auctioneer who is maybe at the end of the day and they don't want to do the mathematics or anything like that, start the bidding at 1.590. Because what the auctioneers then going to do is they're just going to go, round me up to 1.6. And now what you've done is you've set a precedent that the auctioneer is now accepting $10,000 bids. So I'm going to ask you for 1,615 because I'm going to do the maths, but you can control it. Now, is that going to do anything? Is it maybe going to make it go faster because you're going in shorter increments? Maybe, but at least you're kind of not racing up there too quickly for yourself.
Thanks very much. Sam, you got
So auctions, the auctioneers today, they're just that good. So if you try and bounce them, you know, they're doing 10 auctions a day. So, you know, the old days you used to have someone you made at the front and he'd stop the auction in the middle of it and he'd say, does it include the property next door? And the auctioneer would go, oh, it's too dear, and scream and carry on. Now the auctioneer goes, ha, and just moves on. And then when you bid, you go, see, and he thinks it, like, they're just so good. So who you're up against is you're up against the other bidder. So in the last 2 properties I've bought, you can only save a little bit maybe at the end, I think. You know, it's just that well run. So when you're bidding in, it's just you two. So say it's 4.5 and the guy auctioneer's going 4.210 and he's going, come on, 4.3, you can knock him out. And you just got to look at them, and if you see that they're going to bid, you go to the auctioneer, I'll take that 4.3 bid. Now, the auctioneer's smart, he'll just go, yep, come on, keep on going. But some of them get knocked. But more importantly, the other bidders now, instead of going from 4.2 to 4.3, they're going, now they go to 4.4 or 4.5. So you're taking that small opportunity away from them. Now, as I said, I bought the last 2 properties like that. I really don't know if it saved me any money, but geez, I had some fun doing it.
Thanks. Sorry, yeah, we're coming to the end, unfortunately. Yes, please. What is the question down there?
Sorry, just as much as anything else, an observation as much as a question. In recent months, I've had the opportunity of letting builders into a flat each day to do their work. And basically, these people tell me that week on week, 52 weeks of the year, they basically follow builders around repairing concrete cancer. And that's what they do 52 weeks of the year. So I was very interested to hear you mention the year 1997 before, because basically there are blocks of flats out there that are just shit. There's no other word. And I mean, in the next few years, I've got a daughter who will probably be looking to buy a flat. And, you know, I mean, some of these repairs aren't particularly large, and yet the people who've already got a large mortgage have been asked to pay $70,000 per unit to repair their concrete cancers. So I just wonder whether sometimes, you know, do you get a listing and you go, oh, 30 such and such a street, Clara, my God, that place leaks like a sieve, you know. So these people assure me that 52 weeks of the year they just follow builders around repairing concrete cancer. He wouldn't tell me the builder in question because he'd probably get sued, but it is a huge problem. Yeah, I mean, when I was 20 years old going for my first loan, the bank manager wouldn't ask you what the strata outlays are. But these days, that's one of the very first questions that your bank manager will ask your 21-year-old daughter is, what are the strata levies? Because it's a huge issue, and they just put them up and up and up. And yeah, so I mean, the standard of units out there at the moment are absolutely appalling, and nothing seems to be getting done about improving the finished product. So,
well, first we're going to get Byron to comment on that.
Yeah. I think what we're seeing with new construction is, I mean, a lot of people have experienced significant costings in building, and the quality of those products that are being utilised is in order to get the product out of the ground a lot faster. And still the pricing, even though they're getting the product out of the ground faster, the pricing isn't going down. The pricing for that construction is going up. Now, to go back to what your concern is around these properties and referencing 1997 as maybe a point where construction period before that you shouldn't be touching, or post, I can't remember what the point being, but What I would be suggesting is, if your daughter is going out there to have a look, if the property's already gone through its warts and all and has had the concrete cancer, then go for the property. If you see through your strata search report that there is concrete cancer, then clearly you should be considering some form of adjustment in your expectations of what you would pay for that asset. However, you know, there's the old saying, you know, the lack of due diligence will end up costing you money. So research and do your homework, as Sam was saying, no matter what asset class you're looking at, apartments, industrial, commercial, retail.
It's just, you just got to be very careful with these large number of blocks, because look, 1997 is pretty clear. That's when all the waterproofing's going to run out, okay? Has a warranty of 20 to 30 years. But strata plans can go and borrow money now. So you might have a, a unit that you don't owe any money on it. In the strata plan goes and borrows $5 million to go and fix up a building.
At 11%.
Yeah, from Macquarie, and all of a sudden you've got an unencumbered asset that's just been devalued because someone's highly geared in another unit. And I think that's, I've had lots of fights with, and they are fights on strata meetings about this thing. So they say, well, I can't afford it. Well, you might have to sell your unit.
And are the problems always disclosed in strata? If you have a look at the strata, if you look at you go back and you get the minutes, are you always going to find the problems?
Yeah, if you're thorough with your research in the strata search report, the minutes of the meeting is a true reflection of the conversations that have occurred within the strata meetings, the AGM and executive council meetings. Whatever verbal conversations happen outside those meetings, you're not going to be privy to, so you are taking that risk. However, if it's documented and you read it and it identifies issues, then proceed with caution. Cladding is
Yes. And is the cladding thing being sorted out? I mean, to what degree?
No, it's still there. So does everyone understand the cladding, what happened in UK? So some buildings are still combustible and they've still got this insurance. The insurance industry should have sorted out and said, we're not going to insure this stuff, but they keep coming along and just pay a bit more premium.
No, is there a last question? Sorry, because we are. Sorry. Okay, so let's go down there first. Yes.
Yeah, can you hear me?
Yes, please.
Yeah. It's Victor here, private investor. Since we got all the experts here, I might just ask a question to pick everyone's brain. I just want to know, when we talk about the historical data, right? We're talking about Epping and Burwood, where Epping before, the unit price in Epping now is lower than 10 years ago, and now Burwood is going up. Those two suburbs, they have a very similar background and they have a very similar sort of development going on. So my question is going to that is, question number one is supply and demand. How can we predict where the people is going to driven up that market? So sequentially, that's a residential one, and as a result of that, when we're talking about commercial, we all talk about how many people in the shop line. So that driven up the commercial value as well. And with the new state government development rule implemented or going to be implemented, everywhere along the train line is going to be developed. So where will be the next good suburb?
Yeah, it's a very good question.
Yeah.
Would you like to have a go?
That's a really good question and a lot of crystal ball gazing there. However, I think if you stick to the fundamentals of with this state government policy now, it's I think within 800
You're talking about the type, the type, 800 metres of the railway station.
So, but then you've got to then analyse what is the existing population growth and how strong is the infrastructure surrounding that railway network as well. And as Sam pointed out, I know I'm digressing into the commercial property, and arterial roads, but I think you can apply the same principles to the residential space as well. What are the arterial roads around that particular location?
But sorry, forgive me.
Yep.
In Epping, you would have picked that as a transport hub. It should have been really good. Why didn't Epping work?
It wasn't big enough, and it was split by the railway line.
Yeah.
Like Newcastle. It was split by, once we got rid of the railway line, the commercial centre at Newcastle worked.
So can I change the example? What about Macquarie? Use Macquarie versus Burwood.
So, Macquarie,
Because the unit price in Macquarie is still not growing.
no, but, yeah, so Macquarie's a really interesting example, okay? And if you have a look at, deep down, have a look at the unit prices in Burwood, they haven't really moved like the house prices. But if you have a look at with the expansion of Macquarie, the house prices in Gladesville, West Pymble, they all doubled within about 3 or 4 years. And that's pure because of employment at Macquarie. So the unit prices didn't, but the houses did because families thought before they got on to Mayvale Road.
Sorry, we're sort of out of time, but there are a couple other questions. Yes, please.
Yeah, my question, I've got 4 children, but this is a very basic question. Buying properties at the moment. One here, his foot's in the door with an apartment in DY. It's a very basic question. What is the best, I've got 4 intelligent people in front of me, what is the best advice you could give him? Does he hang on to that property for 5 years? Does he leave, rent it and buy somewhere else? What advice would you give a new first-time buyer of age 29?
What do you want to do?
He wants to make money and have lots of properties, obviously.
Okay. Sorry,
Did you make use of the first home buyers scheme?
I did, yeah.
Yeah.
So now what?
I'll get
Ready
as
to
much
move
of your
forward?
capital growth out of it as you can.
If it's your principal place of residence, it's tax-free on your exit. Equally, we've got some accountants in the room as well. You may consider, I'm always a believer in, if you've got the capacity, don't sell, hold on. You may consider leveraging equity out of that asset, turning that into your investment property, if the strategy of it and the location and what it offers would deem it to be a good investment property, and then take that equity out to potentially buy another property, it being your principal place of residence. So you've got to change your strategy, but you need a lot of advice once you start making these decisions, or before you make those decisions, because you can get caught down the track with on exit strategies of capital gains tax, etc., which is can hurt quite considerably.
Refer to your accountant, but I've done all right paying off my principal place of residence, and that's what you just throw everything in. Once you get rid of your principal, any loans on your principal place of residence, you can't turn that into a property because there's no gear, into an investment, there's no gearing. It just gives you such a step up in life. And when you pay it off, use that equity and go and gear up. Gear up. Put yourself under pressure. Have a crack.
He's working hard.
Forgive me, that seems like, I know there are other questions, but we would wrap up at 7. I think the panelists will probably be around to answer questions if you'd like. But I think that's a very good place to finish. And perhaps we should thank the boys. Thanks, Byron.
So, I want to thank you, Rob, an excellent job, and thank you to the team, Byron, Jake, Sam. A few bombshells there. I'd like to officially distance Dunford Brown from the Gear Up recognition. However, if you are going to do it properly, it's maybe a slightly safer bet. But guys, a really entertaining discussion. I'm sure you're going to get hit up with a lot of questions afterwards, and thank you very much. thank you for making yourselves this evening, and thank you all for joining us. We always appreciate your support and lots of questions there. So have a wonderful evening. Thank you.